learning about cost behavior and specifically cost volume profit analysis. So for the purposes of doing cost volume profit analysis, it's very important that we understand basic cost behavior. So we are going to talk about variable cost, fixed cost, and mixed cost. We're going to begin by talking about variable cost. The key behind costs that are classified as variable is that they vary in direct proportion to the production volume or sales volume. What you'll find is there will be a variety of cost in the business that may not be exactly the same every month or every period, but if it doesn't vary directly in proportion to production volume, then it's not a variable cost. The most common examples of variable cost are going to be direct materials and direct labor. Clearly, the more units we produce or manufacture, the more direct materials we're going to need, the more direct labor that we're going to need. So that is the most common example of variable cost. Okay, and here's an example. It says, assume that Jason Sound produces stereo systems. The parts are purchased for $10 a unit and then assembled by the company. Direct material costs for the relevant range of 5,000 to 30,000 units of production are as follows. And what we see here is while the total material cost goes up as we produce more and more units, the amount that we're paying per unit doesn't change. And another thing that I want to point out here is this concept of relevant range. We normally talk about it when it comes to fixed cost, but it could be relevant when we talk about variable cost as well. The relevant range is simply the range of activity where the cost doesn't change, okay? For example, in this case, the company is able to get these supplies for $10 per unit, okay? Assuming that they produce at least 5,000 units and no more than 30,000 units, okay? So we would think, well, why might that change if we go outside the relevant range? Well, if they're producing 5,000 units, maybe they're getting some kind of discount or some preferred rate that they would not otherwise get, if they were only, say, producing 500 units or 1,000 units or something like that. And very similarly, if they go above, 30,000 units, it could be that they would be able to purchase so much from the supplier that maybe they could get an even better rate than the $10 per unit that they're paying right now. Maybe that cost could go down to $9.50 or $9 or something along those lines. But that's the whole idea of a relevant range. And we're going to talk about it when it comes to fixed cost as well, because it tends to be especially important as it relates to fixed costs. So I really like this graph here because it presents nicely the real behavior of variable cost, okay? So we see that total cost, when we're looking at variable cost, it's a linear relationship. As production volume increases, the variable cost increase in direct proportion, okay? But on a per unit basis, the cost remains flat, okay? So it's $10 per unit, no matter how many we produce, as long as we stay within that range. But the more we produce, the more the total cost is going to be, okay? And this just shows an example of, different companies and what they might use as an activity base for their variable cost. But again, it's, it's going to be those things that vary in direct proportion to the activity. To me, one that makes a lot of sense here, if we look at the hotel, housekeeping wages, it's going to be based on the number of guests. We're going to need twice as many housekeepers if we have twice as many guests and that sort of thing. Now, let's take a look at fixed costs. So fixed costs are the costs that do not vary in direct proportion to changes in activity levels. For the most part, they remain the same regardless of production levels. Now, again, that's not to say that they might not change slightly, from period to period. Okay, for example, things that would be a standard fixed cost might be, the lease on the factory, or maybe property taxes on the factory, things like that. Now, again, that's not to say that it might not increase from one year to the next, or from 1 month to the next, depending on what it is. But it's not changing because of production volume. Okay, so that's the real key with fixed costs. It doesn't change based on production volume, and it stays relatively flat regardless of what we are producing. Okay, so here we're looking at a different company. This is a Minton company. They make bottles of perfume. And so they have a production supervisor, Jane, here, who's paid $75,000 a year. So for the relevant range of 50,000 to 300,000 bottles of perfume, the total fixed cost for the production supervisor is going to be $75,000. So it's going to remain flat in total, but the more units we produce, the lower that allocation becomes on a per unit basis. Now, remember I said the relevant range becomes especially important when it comes to fixed costs. So what we can kind of assume here is that, this one production supervisor is able to properly supervise and manage a production floor that's making no more than 300,000 bottles of perfume. If they make more than that, then I'm guessing, production is so substantial that they may need to add another production supervisor, which of course makes the cost go up. One of the primary constraints that we often see with relevant range in terms of fixed cost is simply the factory. We may have standard amounts that we're paying for the factory, for the equipment in it, and that sort of thing. But that factory is only going to be able to manufacture up to a certain capacity. And if we want to take our production volume above that, then we may need to actually expand the factory, whether that's buying new machinery, or actually maybe, renting more warehouse space, or something along those lines. So that's why I say relevant range becomes especially important when it comes to fixed costs, because there's usually some point at which, if we go over that production level, we will have a big jump in fixed costs. So that's always something for us to keep in mind. Now, let's look at a similar graph for fixed costs. And what you're going to notice here is kind of the opposite behavior that we saw with variable cost. In this case, fixed costs remain flat in total. However, on a per unit basis, because the cost is being allocated out, fixed cost is allocated out as part of overhead, okay? So because it's being allocated out, the more units we produce, the more units we have to spread that total cost over, the lower the cost per unit. So I always tell students, you have to be really, really careful in looking at fixed cost on a per unit basis, because it's going to change every single time production volume changes. So when it comes to fixed cost, I actually discourage you from looking at it on a per unit basis too much, because again, it can be misleading, because it'll be completely different if you're producing 100,000 units versus 200,000 units versus 300,000 units. And so those are just things that we have to keep in mind. Now, mixed cost. Mixed costs are those costs that have some variable element and some fixed element. There aren't too many that fall into this category. Some of the more common examples might be utilities. There's usually some base charge for utilities, and then you also get some sort of usage charge. You might see something similar on some phone plans. Maybe there's a base charge, but then you get some sort of, data charge or, upcharge based on usage or something like that. So those would be examples of costs that have elements of variable and elements of fixed associated with them. Okay. So there are some different methods that we can use for separating mixed cost. The cost estimation method and the high-low method are a couple. But basically, when we're doing cost volume profit analysis, we need to be able to separate those components into the fixed element and the variable element. To properly do cost volume profit analysis, we need variable cost and fixed cost. Those are our two categories of cost. So CVP, or cost volume profit analysis, has a ton of uses. Essentially, it looks at the relationship between production volume, cost, and profits, that is net income. So we can look at what are the effects on profits if we change our selling prices? What are the effects on profits if we change our cost? What happens if we produce more or less? So this can be critical when it comes to setting selling prices, determining our ideal product mix, and choosing among marketing strategies. Now, one thing that I want to emphasize here, because when we look at this, we're looking at it purely from an accounting perspective. However, we also have to take into account some economic conditions. For example, companies are not just completely free to set their selling prices. They're kind of bound by competition, right? Because if we price our stuff too high, then people aren't going to buy our stuff. They'll just go buy the competitor's stuff, And so we have to think about supply and demand, and we have to think about what will the market bear, what are consumers willing to pay for our goods. And this is especially going to come into play when we're looking at things like sales mix or product mix. Ideally, we want to produce and sell as much of our most profitable products as we possibly can. But again, we're limited by supply and demand. So it could be that some of our more profitable products, maybe they don't sell quite as well as the lesser profitable products, and so we may have to kind of compromise and accept a mix of including some of those less profitable items if that's what the market's demanding. And again, that can help to drive our marketing strategies. We want to push and market those products that are going to be the most profitable for the company. Now we're going to look at some of the key calculations that you're going to need in your assignments this week. First, we're going to start with contribution margin. It's defined as the excess of sales over variable cost, okay? Essentially, what contribution margin tells you is how much you have available to cover your fixed cost. And this can be especially important depending on what sort of operating leverage a company has. That is, how heavily are they invested in fixed assets and fixed costs. So let's look at how we calculate this by looking at an example. All right, so here they give us some information for Lambert Company. They tell us that sales are 50,000 units. The selling price is $20 per unit. Variable cost per unit is $12, and their fixed cost is $300,000. So we can compute contribution margin by calculating sales. So this is just the units times the selling price, gives us 1 million. Then variable cost is the units times the variable cost, so 50,000 times $12 a unit, 600,000. So sales minus variable cost gives us a total contribution margin of 400,000. We can then subtract the fixed cost of 300,000 and see that we would be left with a pre-tax operating income of 100,000. Now, if we wanted to say, well, what is the contribution margin ratio? Okay, this is very simple. We just take the contribution margin divided by sales. In this case, the contribution margin was 400,000. Sales were 1 million. That gives us a contribution margin ratio of 40%. Now, what I think is even more useful is when we calculate the per unit contribution margin. Okay? The per unit contribution margin is very easy to calculate. It is simply the sales price per unit minus the variable cost per unit. In this case, they told us that the selling price per unit was $20 and the variable cost per unit is $12. So $20 minus $12 gives us a unit contribution margin of $8. So what that means, for every item that we sell, $8 of that revenue can go towards our fixed cost. That's the portion that we have available to cover fixed costs. Now, unit contribution margin is super helpful when we start calculating break-even points. As the name implies, the break-even point is the point at which revenues equal expenses. It is the point where net income is exactly zero. So we have no income, but we have no loss either. Break-even point, can be useful for not only, very established companies that are maybe looking to, start new product lines or something along those lines, but it can also be useful for a startup company, when they're deciding, is this a viable business? Can I actually sell enough to make a profit? So break-even calculations are very, very helpful, and it is super easy. We simply take our estimated fixed cost, divide by the unit contribution margin, and that gives us the number of units that we have to sell in order to break even. So let's look at an example. All right, this is another company. This is a Baker Corporation. All right, so what we know about Baker is they have total fixed cost of $90,000. They sell their products for $25 a unit. The variable cost is $15. So remember, we calculate unit contribution margin as the selling price minus variable cost. So that means the unit contribution margin is $10 per unit. So we want to know, how many items does Baker have to sell in order to break even? Fixed cost of $90,000 divided by unit contribution margin of $10, 9,000 units. If they sell less than 9,000 units, they will have a net loss. If they sell more than 9,000 units, they will have net income. If they sell exactly 9,000 units, their income will be zero. They will exactly break even. Okay? And I thought this was a neat little chart, and I believe that you can find this in your textbook as well. But this just kind of shows the relationship between selling price and cost and how it affects the break-even point. So I just thought this was kind of neat. This is something you can certainly bookmark and refer back to. Next, let's take a quick look at target profit, because this one is very closely related to break-even, okay? And as you look at this formula, you're probably going to see just how similar it is. When we're looking at target profits, we're basically saying, okay, we don't want to just break even. Clearly break even is helpful, when you're assessing the viability of something. But ideally, we want to make money, right? We want to make a profit. So what we can do is we can calculate using a similar formula how many units we have to sell in order to achieve some desired profit level, okay? So what does the formula look like for target profit? All right. Remember, when we calculated break even, we simply said fixed cost divided by unit contribution margin. This time, we're going to say fixed cost plus whatever we want our target profit to be. Okay, so if we say we want our target profit to be $50,000, then this is plus $50,000. Okay. Now, one really important thing that I want to point out here, and this is going to be super important if you're doing these calculations in Excel. you absolutely have to put the numerator in parentheses, okay? Otherwise, your calculation will not come out correctly in Excel. You absolutely have to put parentheses, whatever your fixed cost is, plus whatever your target profit is, close parentheses, divided by, and then whatever your unit contribution margin is. And this just goes back to the order of operations in math. And I know for a lot of you folks, that was a long time ago. I understand completely. But what will happen is if you don't put this in parentheses, it will do the division. It will take target profit and divide by unit contribution margin before it adds in the fixed cost. And again, your calculation will be totally incorrect. So the good news is this formula is super similar to break even. So if you can remember one, you can probably remember the other. The only little caveat with this one is if you're using Excel, make sure you put this in parentheses. Okay, so numerator goes in parentheses and then you will be all set. So let's look at an example of what this looks like. All right, so this time we're looking at the Waltham Company. They have fixed costs of $200,000. They really want to make a profit of $100,000. All right, their unit selling price is $75. Their unit variable cost is $45. That leaves them with a unit contribution margin of $30 per unit. Okay, so we are just going to plug this into our formula. Fixed cost, $200,000, $200,000. Target profit, $100,000, $100,000. So $200,000 plus $100,000, that's $300,000 divided by the unit contribution margin of $30. We get 10,000 units. If this company wants to make $100,000 in profit, then they have to sell 10,000 units. They sell less than 10,000 units, they'll make less than 100,000. More than 10,000 units, they'll make more than 100,000. Some other things that you're going to want to look for in the reading this week, they show some pretty good examples of some cost volume profit charts, sales mix analysis. Again, that's useful when companies are selling more than one product and they have different sales price and different contribution margins, and we want to know what should we sell more of, what should we sell less of, margin of safety, operating leverage. Again, operating leverage is especially important when we're looking at that relationship between variable cost and fixed cost. So I hope that this brief lecture overview has been helpful to you. As always, if you encounter any questions at all this week, remember I am here to help.